Welcome to the next episode of Decode. Today, we are decoding one of the most sought after categories in mutual fund investing, thematic funds. Hi, Shyam.
Hi.
Shyam, thematic investing intrigues me a lot because I started investing in 2007 8 when at that time I remember infrastructure, power, they were all big themes right then, and a lot of people invested and later on also burnt their fingers. Now, I look at thematic investing since the SEBI recategorization happened a few years ago. And I find that innovations have happened only in that segment. So much so that, almost 5 lakh crores is there in the thematic space today, equivalent to flexi cap or small cap and mid cap categories. So there's been a profusion of thematics. At that point in time, I remember everybody said it's very high risk, be careful, and all that. But
In
today,
2008.
in 2008, so now today I see everybody investing in thematics. So, do you still consider that thematic investing is a high risk space where investors should tread with caution?
See, thematic investing is both good and bad. It depends upon how you handle it. You gave a very good example of 2008. In 2008, I was of the view that you should not invest in those teams which were the darlings or the favorites of the market. Very clearly, I was against it. In fact, I used to ask people, why are you launching these schemes? Because I knew for sure that people are going to lose money in that team. But 2 years later, I was interested in investing some teams in 2010, and they were not infra or power. It was FMCG and pharma. Another 2 years later, I was interested in investing in IT. So there is a context for investing in teams. Now we are in 2026. In 2024, I took an exactly similar negative view on tech. When everybody was, going gaga over investing in tech, saying that you can never lose money in tech, saying that this is a very safe industry. The point is, in thematic investing, what you pay really matters. You cannot overpay. And the only time you do thematic investing is when you are getting it relatively cheaper than its own historic average valuation. Suppose a sector is always traded at, let's say, 25 times. You should be getting it at a good discount to that one. Otherwise, your next year forward multiple should contract so much that it becomes as attractive as I expect it to be. It should become that much cheaper in 1 year. So you're just giving 1 year of time for a team to come to a zone where you will be extremely interested and attracted to own that team. So effectively, thematic investing has to always be viewed in an asymmetric way. You cannot just go and do thematic investing whenever you feel like it. You have to do it when nobody feels like it. When valuations are such that people feel, oh, it can go down further. I gave you the example of 2024 when thematic investing in tech funds became a risk. Now, you're seeing that people are very averse to investing in tech funds. We are collapsing the stock valuations of our companies based on what happens overnight in IBM, based on what happens overnight in Accenture. We don't have visibility into what our companies will become in the next 2 or 3 years. But look at the valuation. It's way below its historic levels. Also, our companies continue to have solid cash flows, which they can use to do market buybacks. Because I think market buybacks are imminent in the next few months. I think SEBI will be more inclined to permit that. That's what we are hearing from newspaper reports. So all these factors basically reduce the downside risk. You look at thematic investing when it's a situation where heads you win, tails you don't lose too much. That's how you view thematic investing. Whereas I find most people are chasing themes at the wrong time. So I'm not against thematic investing. This is my approach to thematic investing. This is how it's done in a safe way.
But when you look at it from the outside, the exact opposite seems to be happening, at least until now. For example, when a theme is picking up and when a theme is doing very well, you have a lot of new fund offers in those areas. Now, people tend to also fall for that trap. So, why is this happening again and again? See, the manufacturers also, try to time the market so that they can get maximum inflows, and the people also fall for that. So, how do we correct this mistake?
See, I would, as an investor, always hold myself accountable for where I invested personally. In 2000, when tech stocks were 100 PE, we stayed away from the trade. We stayed away for 2 years when everybody was, performing very well. We were invested in companies which were value stocks. We didn't go anywhere near that space because it was risky. Similarly, in every cycle, we have avoided something or the other. 2008, I avoided infra, power, and the capital goods space. It was a difficult decision. But I felt that what was going on was clearly too frothy and kind of, we were in the middle of a bubble. So I avoided it. But most people want to have that action. Like you want to have a piece of that action. You don't want to miss out on anything.
Yeah.
So I think that when you do that in mutual funds, it is natural for manufacturers to give you a product to do it. If you're doing it in individual stocks on your own will, why can't a manufacturer give a product which somebody else can buy who can't buy those stocks? So it's a free world, but it is the investor's responsibility to make his choices diligently and not tell why is that manufacturer selling this product at this point in time. It's like sin good. See, when you buy at a valuation which is not right, it's the financial equivalent of buying a sin good. You consciously buy it. It's not that you don't know. Because of your greed, you're buying it. So I think that I won't blame the manufacturers. I think I would take responsibility for my own actions as an investor.
Okay.
I think investors should learn to do that. Teams will always be around. Whether the valuation is low or high, the teams will always be around. The funds will always be around. It's up to you to stay clear or steer clear of a overvalued theme and run into an undervalued theme. You can't do the reverse, where you'll buy all the overvalued themes and sell all the undervalued themes. Then you can't make money. It's as simple as
Yeah,
that.
I understand. So, told me two things here. One thing is identifying the right theme, and number two is the right theme at the right time. As an advisor or as an experienced investor, it is very easy for you. But what about investors who do it on their own? Is it so easy for them to identify this?
I think it's well within people's grasp to do this. Yes, just that you need to concentrate. See, thematic investing is what is otherwise called as contrarian investing. You have to do your thematic investing only as contrarian investing, not in any other way.
Okay.
So you have to develop that contrarian bend and ask yourself, is this a valuation at which I must invest? Is this something which I should do? Ask yourself that question. Otherwise, you will have to calibrate your actions. You can't rush in with go all in, and then go wrong. So the way you go in itself is very, very critical.
Okay.
So ask yourself that question. Is this the time for me to go contrarian in this theme? Can I go? If I go contrarian now in this particular theme, what is my downside? All right.
Okay.
And how will I mitigate the risks? Do I have a risk mitigation plan? Once you are clear on these two things, you will know, okay, I'm going to do this if this happens. Alternately, if it goes up, no problem, I have put enough money.
Okay.
So you will, in your mind, figure out what suits you, what is aligned to your risk capacity, and what will match your risk profile.
Okay. Okay. So, on the other hand, if you choose to go with an experienced advisor, blindly trust the advisor, a lot of contrarian investing also happens in very early stages, which means that there is a lot of chance for that investment call to go wrong, and also a lot of chance for that investment call to take years to kind of fructify. For example, I remember Prashant Jain's call on PSUs. It was very, very, very early, and a lot of people weren't very keen on it at that point. But later on, he was proved right. So, how does an investor navigate these circumstances?
Actually, the same thing has happened to me as a mutual fund advisor. But to be fair, Prashant waited for a much longer period. For me, it was just a few years, 2, 3 years. But in that interim period, see, most mutual fund investors don't want to see 1 year of negative returns or 1 year of zero return. So they think that a mutual fund should also behave like a deposit. That's the psychology, that's our wiring. So if I'm early in a fund, which is a thematic opportunity, sometimes teams take longer to play out. See, what is the cycle for a team to play out? From the time you enter, it could be anywhere between 4 and 7, 8 years.
Yeah.
Now, what do? We wait and then turn contrarian. We may turn contrarian at the midpoint of this 8-year cycle. At the fourth year, I may become a contrarian. From there, it has to go up. No, it may not do anything in the fourth year. It may even go down in year 4, then stay there in year 5, go up in year 6, go a lot more up in year 7, and blow out in year 8. So it's a 4-year wait from year 4. The 5th year it plays out. For us, it was just a 2-3 year wait. Investors can become very impatient. They think you made a mistake. It happened to me in the same PSU team. It's happened in multiple teams. Why are you doing this? Why are you doing this? In 2013, people are asking the same question, small cap. Today, you are in a situation where people don't want to invest in anything except small cap and mid cap. In 2012, when I was giving mutual fund related advice, people would say, why are you investing in small and mid cap? Why are you not going into top 200 or some fund like that, which we were avoiding at that time? So high conviction contrarian teams will always face that kind of a gestation. And let me be honest, only the investors willing to wait will win in this. I mean, if you're traveling from one place to another, your flight is at 10 a.m. You can't say every time I'll reach the airport at 9 a.m. and catch that flight. 2 hours before means you have to go at 8. Chances are that you will reach at 7:30 or 7:45 because that's your personality. It's mine as well. You don't want to go the nick of time. But most of the people don't want to do that, especially in their investing. So if you want to do thematic investing, you must be flexible only on one thing, that is time. Because you don't control that. The market controls it. Saying that you are very clever and you will just get onto a theme just in the nick of time, not happening. It's never going to happen.
Understood. So that brings me to this question on SIP versus lump sum investing in thematics. For example, in Milestones to Wealth, in my own portfolio, I've been advised SIPs in a particular thematic fund, and I get lump sum calls for some other sectoral or thematic funds. Now, before I came in here, I was always investing only lump sums in thematics. Now, this is a different strategy for me. So, when do you do SIPs, especially when you have a long gestation period, and when do you do lump sums?
Actually, that's a very, very good question. In a thematic fund, if you're going to do a SIP, you're going to do that SIP when you estimate that the gestation may be, let's say, at least 1 year or 2 years. So the SIP keeps going in a very disciplined way during this gestation phase. All right? In between, let's say it falls a lot. At the time, you can even do a lump sum into the same theme where you're doing an SIP. All right? So you actually scale up during this gestation period, which could be anywhere between 1 and 3 years. So the SIP should be given only if there is a gestation in a thematic fund. Now assume I am not able to visualize that gestation. I'm not able to predict that gestation. So there will be situations you cannot predict. Like today, it is difficult for me to predict the gestation in tech funds. It's become difficult. So what do? I use only lump sum. So I will not do SIP in tech funds at this point in time. I will try to build that position where I cannot predict, where I cannot visualize when it's going to turn. I'll do it through lump sum only. So I think that which is better is a mix of strategy and tactics. Okay, doing an SIP during a gestation period is strategic. Doing the lump sum when it falls further is tactical.
Okay.
So you actually bring down your NAV cost
Mm.
significantly,
Mm.
right? The
Okay.
strategy keeps running.
Okay.
Tactics keep coming
Okay.
in a timely way.
Mm.
Now, where you cannot do it in a strategic way, suppose, like I mentioned tech to you today, there could be other sectors also which suddenly run up,
Mm.
and I don't want to start the SIP there.
Mm.
So I'll shift to a lump sum mode and keep on doing 4-5 lump sums
Okay.
over a period of 12 to 18 months at least.
Okay.
If possible, I'll do more also. I'll break it down into smaller sums. So the risk mitigation happens also. You normalize your acquisition cost nicely over a period of time. And you actually enjoy investing. There's no stress. This business of catching the bottom, no. I don't think you can do it in mutual funds. If there is a move like this, like a saucer, you invest right to the bottom mark and you will get a good average, right? Very close to the bottom. Maybe 5 or 7% or 10% above the bottom, which is good enough now.
Okay.
Why are you trying to catch the bottom doing lump sum? Or why are you trying to catch the bottom just doing an SIP? Try to use lump sum effectively.
Okay.
And where you can visualize the gestation, use an SIP.
Okay.
This is how I would view thematic investing.
Okay. Okay. The other important question here is what percentage of your entire mutual fund portfolio be in the thematic or the sectoral funds category? I mean, to make a big difference, and what percentage would be risky?
See, these guys who write all these stories on how much it should be, how it should be, frankly, I am not impressed with the understanding of investing itself, portfolio construction. Because the whole market is nothing but an aggregation of various themes. Now, if you take, let's say, the Nifty, it has a very high allocation to financials. It used to have a double digit allocation to IT. Now it's down to 7.5. Similarly, it has got other industries exposures. Now, if you are going to build a portfolio of thematic funds, you are going to move away from the allocation of the Nifty to build another portfolio. If Nifty, with its asymmetric allocation to specific industries, is a safe investment, how is your portfolio, which is constructed to have a relatively better allocation, where you reduce some areas which are overexposed in the Nifty, you avoid some sectors or themes which are, overvalued and or you feel they don't have a great future, and then you give a higher weightage to some other sectors which are in your favor with respect to valuation and also with respect to visibility of earnings growth. So you are just assembling a portfolio which has got a better chance of beating the benchmark by using the very components that are there in the benchmark in a different way. How does it become extremely risky? I don't understand this. It's something that somebody who doesn't understand this equity construction or portfolio construction philosophy has made into theories and generalized. And this has been, you have been probably reading this literature for last 20 years. But when I show you a portfolio, you can easily tell me there's no risk in it. If I go and buy single theme 50%, then that is wrong. But if I am having no theme above 25%, I'm actually taking a more balanced view than the Nifty. And if I'm weighting defensive themes higher in a difficult market, when their valuations are in my favor, actually I'm doing superior risk management over the index. So it's not a question of thinking that if you do thematic investing, everything is risky. I think that's a very reductionist argument. I don't believe in it. I would happily reject it.
From what you have been saying, thematic investing seems very tactical. So you enter at the right time, you have a good exit strategy, you make the maximum, and that's how you go about it. But then there are people who want long-term approaches, who don't want so much churn, who are willing to wait through multiple cycles. Suppose you do thematic investing in a cyclical category like an auto or an infrastructure. Metals. There could also be structural themes like consumption, evergreen themes like dividend yield. So, is following a multi cycle approach a wrong way to invest in thematics?
It's not a question of being a wrong way. Your economic cycles are much shorter today.
Mm,
One,
mm,
your volatility is much higher today because of geopolitics and various other things.
mm,
How can you say I'm going to invest for multiple cycles? If you had invested
mm,
based on this multiple cycles
mm,
theory, how would you have factored in COVID
mm,
into your investing?
mm,
And what is your response to that?
mm,
How would you make the best of that opportunity?
mm.
So I think having this flexibility is extremely important.
Okay.
You should be open minded.
Mm,
You should be very well prepared.
mm,
And you should not worry about being a perfectionist in predicting.
mm. Okay.
That's one point.
Mm,
So why do you sell a theme? I'll come to that. You're saying it's very tactical.
mm,
It's not tactical. It's
okay.
largely strategic.
Mm,
Tactics are required to, string together a strategy. Sometimes, as I told you, I'm not able to visualize or predict
okay.
what will happen.
Mm,
So I make 4 or 5 tactical decisions.
mm,
Those 5 tactical decisions eventually form a strategic intent.
okay.
It becomes a strategy.
Mm,
And I don't sell within 1 year.
mm,
None of these themes generally play out within 1 year. Rarely only you'll see a theme playing within 1 year.
mm.
In my 16, 17 years, it's not a regular
Okay.
incident. It's a rare incident.
Okay.
Most of the time, teams take between 2 and 3 years, sometimes 4 years.
Yeah.
So it's as long term as any other investing can be.
Okay.
Right? Suppose it's 2 years and the team plays to its full potential. I feel uncomfortable about that very theme,
Mm,
which I felt so attracted to 2 years ago. I feel the valuations are very high.
mm,
I change my stance
okay.
and then again look for safety.
Mm,
It's just the thing you do if you're a equity investor doing direct equity. You would always want to go to safety.
mm,
Why would you stay in a place knowingly,
mm.
when you are clear that the risks are rising and too high for your comfort? Then
Okay.
that time you have to get out.
So, for example, how I approach, so I've been tracking, say, auto sector for a long time. So I always have had exposure to a thematic fund in that space. So for me, I will have a threshold return below which I wouldn't want the fund to go. Whether this, I know the cycle is 3 to 4 years, and whether it's the cycle is in favor or out of favor, I have a threshold return number in my lump sum investing in the theme. So if I feel that the fund is falling below the threshold return that I have, then I would use it as a strategy to sell. Otherwise, I wouldn't touch it. I would allow it to play it over multiple cycles. You think that this approach is something that investors cannot adopt?
No, why would you sell just because the returns are low?
Mm,
My question is,
mm,
when the returns are low, I ask myself a fundamental question.
mm,
How do the valuations look
Mm.
from a futuristic standpoint?
Mm.
I'm not worried about the return at all.
mm. Okay.
If I'm convinced that the valuation is attractive
Mm.
and the future looks brighter,
Mm.
I'm not worried about the past return.
Okay.
I would go all in at that time actually.
Mm.
Why would I
Okay.
sell?
Mm.
This is where I have a lot of issues with a lot of investors because
Mm.
they are all reading the literature that is available publicly,
Mm.
and the literature doesn't factor any of this in.
Okay.
It's completely rear view mirror driven.
Okay.
And they would come and give me gyan. No, this
Mm.
got this star ranking in this platform.
Mm.
That fellow says it is 2.5 star or some
Mm.
rubbish. I don't know.
Okay.
I mean, to me, it doesn't matter. I'm looking
Okay.
at the portfolio. I see that the portfolio will do well.
Mm.
I have the conviction and I want to go in.
Okay.
That's all.
Mm.
No disrespect to all these rankings
Mm.
because they catch this late.
Okay.
2 years later, it will come to 5 star
Mm.
or 4.5 or
Mm.
whatever. I don't
Mm.
even look at it.
Mm.
Fine. That's how that operates.
Mm.
But you can't make money by following that.
Mm. Okay. I had a friend about 2, 3 years ago. Now, this friend came to me with a very interesting strategy when defense NFOs were at its height. So this friend came and told me, I know that this theme is playing out and I need money for the short term, say in the next 1, 2 years. So somebody is pitching this defense NFO to me and I know that I can probably make money in 1 or 2 years. Do you think it is a good strategy to invest in this theme? In which you can make money in a short period of time. So usually when I approach somebody, they say, if you want it within 1 or 2 years, do it in debt funds. So, but this seems to be an interesting approach to adopt. So how would you look at this kind of a reasoning?
Honestly speaking,
Mm,
that success
mm,
in the defense team
mm,
was a one-off.
mm,
I would not have ventured into
mm,
investing at that level in an aggressive way.
mm.
But the momentum was on the back
Okay.
of the team
Mm,
and it lifted the team
mm,
like anything.
mm,
I don't think that such a thing can happen often.
mm.
It's a rare incident.
Okay.
and I won't generalize that that's how you should invest. It's one of the rarest instances when a team which is already run up, ran up even more and went to levels which are crazy. And I would think that it went up to that level simply because of the misallocation of capital by investors into the defense fund, because they are forced to buy the same companies at higher levels. Now you can come back and say, look at the returns they made, because statistics can be illusory. Your own behavior creates that return. Right? When you are not behaving responsibly with capital, that can also be seen as returns. No, we are seeing it today in some spaces. So I think that that is something that I would not generally bet upon, because I want to be responsible in how I allocate capital. I want to be very careful in what valuation we invest in, and I want to have a fallback if something goes wrong. Suppose in the near term you have a Iran war type of a thing, or a Ukraine war, or maybe COVID, or whatever happens. When you have an incident like that, I want to have a comeback. I want to have something which I can do, which can correct the situation, which can remedy my earlier investment, and again put the investment on the path to capital gains, on the path to success. So that is something that's very important to me. So I would not venture to invest in this kind of NFOs generally, which are already coming after the sector's run up, hoping that it would become even more frothy in terms of valuation, and people will become more irrational. It's a rare incident, but yes, it happened. But I would have definitely sat out of this.
Shyam, the other thing, a very interesting thing about thematic funds is that every fund house has a fund in that category. And if you think that a particular theme is going to do well, which fund house do you choose? That's a big question, isn't it? Because if you go and start viewing their portfolios closely, everything is positioned very differently. So which positioning is going to take you forward? It's a big question for investors. So how would you answer this question?
I'll give you a good example. In recent weeks, we were looking at the tech funds. Now, one fund has a complete domestic portfolio. Some others have all kinds of stocks in them. They have the IBMs of the world, the Accentures, everything. My view is to avoid exposure to global companies at this point. So we went and looked at the company which has got purely domestic portfolio. And second, some people take too much risk in a thematic fund. For example, they buy more of the smaller companies. Then they go and buy something which can technically, fits that fund, but it violates the morality of investing in that fund. Like, for example, a tech fund has got very big position in Bharti. And something else which is unconnected. I don't want to name the other company. Now, I don't want to invest in these kind of companies. You go and buy something else, which is not a tech company. So, where it violates the spirit, we'll just move that idea aside. So we'll look for businesses which are correct, where funds have constructed with the right kind of businesses, risk management is correct, valuations are in our favor, and the fund may not have done well, or it's looking very bad now. Any revival in that theme will do wonders to that fund, simply because of the integrity of the fund, its true to label spirit, and the fund manager's risk management. These are things that are very important. In most of the funds that I have seen, they have done all kinds of compromises. Now I ask myself a question: will this compromise actually work, or it will cut the other way around? If I feel that it will be counterproductive, I'll just ignore that fund and move to the fund who's done things which are sensible. So that's how you eliminate. I would not look at past performance and buy products in teams. I would look at the portfolio and buy a theme. And within a theme, I will look at all the funds and decide which fund is true to label, which fund has got the right positioning for the future, which fund has the right kind of manager, and how much that manager has conviction in that product.
Understood. And so, midway through when the theme is running, would you make course corrections if you think that fund is no longer convincing?
Definitely. Definitely. Once you know something is not working and something has gone wrong, you will have to walk out. On the contrary, if you feel that something is going too good and right, and the market is not taking the cognizance of that, you will go all in again. You will put more money. Both can be done.
We hope you got the nitty gritties of investing in sectoral and thematic funds right at the end of this conversation. Thanks a lot for watching. See you in the next episode of Decode.